The biggest company in the world, Apple, is finally catching up with the 2022 market crash. Their stock price was holding up pretty well until rumors about a slowing demand on the iPhone 14 came out. Maybe you are thinking, is it time to buy and join Warren Buffett as a shareholder? Will an apple a day keep my losses away? I got good news for you. I'll show you why I think Apple is the best stock to shareholders in the market, going through the main pros and cons I see for its business and stock. I'll also calculate its valuation in order to figure out if the current price is undervalued or overvalued, according to my assumptions. Spoiler alert. One of my scenarios comes up with a 49% upside potential. Let's begin. Pro number 1. Apple's ecosystem and moat. Apple is the king when it comes to electronic devices, such as the iPhone, the AirPods, Apple Watch, Mac computer, and the iPad. Their customer base is so big that 50% of smartphones users in the US have an iPhone. And it increases to 78% when considered only high-end smartphones. As Steve Jobs once said, and I quote, "Quality is more important than quantity. One home run is much better than two doubles." This philosophy brought Apple from the ashes in the late 90s and still remains in their culture today. Their loyal customers know and expect that in all products. Great quality, beautiful design and easy to use. Another great perception Apple has from its customers is the respect for privacy they have. Something they have always made sure to point out. Put these things together and you get pricing power, along with the ability to constantly launch new products with great margins, immediately pushing sales and profits higher. Let's take the AirPods as an example. In 2019, Apple took it out of the iPhone package without reducing the price. They made a few improvements and started selling as a separate product. 1 year later, in 2020, the yearly AirPods sales were $23 billion. Much higher than the entire revenues generated by big companies like Adobe, Uber, Nvidia, Spotify, and Twitter. They are now using this strong ecosystem to get heavy into services, which I'll speak more about in a few moments. Moving on to pro number 2. Cash cow. Apple generates the most amounts of free cash flow out of all big tech, $108 billion. They generate as much cash as Tesla, Meta, and Google together. The same is true if you replace Google by Microsoft. It's just mind-blowing. I left Amazon out of this because they are currently presenting negative free cash flow. I'm not saying Amazon is a bad business, I actually like it a lot, they just operate in a unique way, which I'll explain better in my next video. Getting back to Apple being a cash cow, their earnings just keep increasing, year after year, with a few exceptions here and there. Last year alone, 2021, it went up 57%. This recent jump is not only due to a simple increase in revenues, but its quality is also getting better, with higher margins. Physical products usually have much lower margins than online services, areas that Apple has been paying more attention for the past couple of years. What takes us to pro number 3. Services growth and margins. Apple's revenue breakdown by category shows that services represent only 20%. But this number is growing much faster than all the other products. Services revenues grew 12% in comparison with the same period last year, while products revenue actually decreased 1%. Also, as I previously mentioned, services have much better margins. Their gross margins on products is 35%, which is pretty good for physical goods. But on services they get 71%. In case you are wondering what these Apple services are, they include a bunch of things like music, movies, gaming, and more. Prices are pretty competitive, which is not usually the case with Apple. Their services bundles are called Apple One, and its prices are pretty close to Netflix subscriptions, that is just for movies and series. You gotta add another $10 for Spotify if you wanna listen to music. One last great aspect of the service business is the predictability. Recurring monthly revenues is nowadays considered the best business model, the so famous SaaS business. I go deeper into it in my Microsoft video, the link is on the description, in case you are interested. Moving on to pro number 4. Advertising. In 2021, Apple changed its privacy policies, allowing iPhone users to disable advertising tracking data on their phones. This action made social media companies to lose a lot of knowledge about their users, and consequently advertisers are now getting lower returns on their ads. According to Meta, this change caused them to lose $10 billion per year. And guess who has a lot of mobile data and is now accelerating its advertising business? Well, Apple is the one. And they are now growing faster than both Meta and Google on advertising. Pro number 5. Cash and debt management. Usually having a high debt in relation to the company's cash balance is a pretty bad sign. But not for Apple. If you saw my videos on Meta, Google and Microsoft, you know all these companies have huge amounts of cash and very low debt. Apple does it different. They are able to acquire debt with very low interest rates, much lower than their returns on capital invested. So it makes sense for them to borrow money and use it to repurchase its own shares. And the fact that Apple has a relatively low cash balance is actually a good thing. Considering their ability to constantly build great profitable products and services, it's important that they are always putting money to work instead of having a ton of cash laying around. Also, just in the last 12 months, Apple generated $108 billion of free cash flow and has $131 billion on long-term marketable securities. So, when it comes to managing cash and debt, they do it in a pretty smart, safe and efficient way. Pro number 6. Share buybacks. If I had to choose one term for describing Apple as an investor, would be shareholder-friendly. In terms of returning value to shareholders, no other company does it as well as Apple. Look at how much their shares decrease every year. It's incredible. They are doing around $160 billion per year in share buybacks. If we add dividends, returns to shareholders sum up to $200 billion in the last 12 months. Just to illustrate how crazy this is, let me show you a few companies that are worth less than $200 billion. Disney has a current valuation of $177 billion. Nike's market cap is $137 billion. And Adobe is being valued at $134 billion. This is one of the main reasons Warren Buffett invested in the stock. And he didn't do it lightly. Apple represents 41% of his portfolio. In 2020's Berkshire letter, Buffett wrote, "When we finished our purchases in mid-2018, Berkshire's general account owned 5.2% of Apple. Since then, we have pocketed $11 billion by selling a small portion of our position. Despite that sale, Berkshire now owns 5.4% of Apple. That increase was costless to us, coming about because Apple has continuously repurchased its shares, thereby substantially shrinking the number it now has outstanding." Pro number 7. Opportunities ahead. Following Jobs' philosophy, Apple doesn't do a bunch of average products, and they are often not the first. But they always go after gigantic promising markets aiming to be the best. Another Apple's characteristic is their secrecy in new projects, so I won't have that much information here. But it's known they are working on at least 2 of the most exciting technologies of the next tech generation. Apple announced they will release a full autonomous car until 2025, which is pretty close if you ask me. This has a huge potential. It's gonna be interesting to see their robotaxi battle against Waymo, Tesla, and all the other companies trying to make in this space. If you haven't watched my Google video, I strongly suggest you do. I talk a lot more on this subject, explaining why I think Waymo is ahead at this point. The other big innovation we know Apple has been working on is AR and VR headsets. They will certainly not be left out of the augmented and virtual reality world. Their first devices were supposed to be released this year, but that was postponed to 2023 due to development issues. One detail that stands out here is that according to rumors, their VR headset would cost around $2,000, while Meta Quest, its direct competitor, costs $400. Meta is about to launch their high-end model, called Project Cambria. Its projected price is $1,500. Now, let's talk about the main issues I see for Apple stock. Con number 1. High PE. Taking a look at Apple's historic PE, we can see that we're currently above average. A part of it can be explained by the higher growth they had in both sales and margins in the last few years. But still, considering analysts' growth estimates for the following years, it does seem a little expensive. A 6% revenue growth next year and 9% average growth for earnings in the next 5 don't really justify a 23 PE. Unless they end up to be wrong, which happens a lot. We never really know what kind of cards Apple's got up their sleeve. It's also important to keep in mind the share buyback effect. This gets more clear if we compare their growth on earnings and earnings per share. We can see their EPS grows much more than earnings. We will find out later on the video if current prices are really all that high. Con 2. Highly concentrated on iPhone sales. iPhone sales represent 52% of Apple's total revenue. This is a big risk for the company. If customers decide they don't need to update their phone every year, their huge profits will be seriously compromised. So far they've been doing an excellent job with each update and managed to constantly increase demand. Recently, a rumor came out saying demand for iPhone 14 came in below expected. But keep in mind this has not been confirmed by Apple. In fact, one of Apple's main suppliers said the demand is cautiously positive. So, we will have to wait and hear from the company in a couple of weeks when they release their earnings report. Con 3. The last risk I see for Apple is their big overseas exposure. 58% of their revenues come from Asia and Europe, and with all that's being going on in the world, I wouldn't be surprised to see weaker numbers in the following quarters. Japan, a big market for Apple, decreased 16% in the last quarter when compared to the same period in 2021. This was due to slowdown in iPhone and iPad sales. I don't see much chance of this happening, but in a remote scenario that China decides to ban Apple, their profits would take a gigantic hit. Alright. Now that we know more about Apple's business, let's go over some numbers and see what a good buying price would be. I built a discounted cash flow model that evaluates companies considering some key data going forward that we input according to our expectations. These variables consider the next 5 years, and they are revenue growth, share change, profit margin, P/E ratio, and expected returns. I also use 3 different scenarios. For the base case, I consider my most realistic assumptions, numbers they will probably achieve. On the best case scenario, I'm more bullish, assuming less probable premises, but still possible. And for the worst case, I'm bearish, considering what I think is a remote chance of happening. For revenue growth, Apple historic numbers are not that consistent, and my personal opinion kind of aligns with analysts' expectations. I think there is a good chance they grow single digits next year, maybe even in the next 2 years, if macroeconomics don't get better. But when I think in 5 years' time, how well managed the company is, and all the cool stuff Apple will come out with, 10% average growth seems fair enough. For the best case, I'll do 12%, assuming things get better soon, the service business keeps improving, and iPhone sales don't disappoint. And for the worst case, I'll go with 6%. Share change. Changes here can always be positive or negative through the company issuing more shares to raise money, which dilutes shareholders. Or by doing share buybacks, reducing the amount of shares in the market and consequently increasing shareholders' position. So, it's a little weird to see, but a positive change here is bad, while a negative change is good. Apple doesn't need to raise money, so they do share buybacks. And looking at their record, we can see they have been doing between 3 and 5% for the last few years. So, I'll consider 4% on the base case scenario, 5% for the best case, and 3% on the worst. Profit margin. Apple used to have a 22% profit margin until 2020. With the higher demand they got in 2021 and services picking up, their margins jumped to 27%. But we've already seen it coming down this year and is now at 26%. I believe their services will keep growing faster than products, so even if we have a few bad quarters ahead, I think 25% average for the next 5 is a fair number. For the best case, I'm considering 2 percentage points higher, 27%. And for the worst case, also 2 points from the base case, but in this scenario, lowering to 23%. Price to earnings. As we've seen earlier, Apple's P/E is currently above its historic average. But as I also explained, there are reasons to support this higher valuation, such as increasing in margins, their moat constantly getting stronger, their sensational buyback program. All these factors make me believe Apple won't return to low 10s anytime soon. In fact, anything below market average I'd say is totally crazy. So, I'll consider 19 for the base case scenario. For the best case, considering they will be doing great on revenue growth and profit margins, I'd say they deserve today's current P/E of 23. And for the worst case, where their revenue growth is only 6%, I'll do 15, the market average. The last input is the expected returns per year. I use 15% for all scenarios. It's a great performance when compared to the market average of around 10%. It also gives a good safety margin in case I'm wrong on these assumptions. Okay, now that we've went through all the assumptions, let's find out what a good buying price would be considering each one of the scenarios. For the base case scenario, the one I think it's the most likely to turn out, we got a fair value of $143. This means that if my assumptions are correct, there is only a 2% difference from current prices. The price I got on the best case scenario is $208. If this turns out to be true, then Apple's stock price should increase 49% just to get to fair value. To finish up, we have the worst case, and this is where things get ugly for Apple. In a scenario where revenue growth comes down to 6% and profit margins keep decreasing, Apple's fair value now should be around $86, a 38% drop from current prices. Keep in mind that this is not financial advice and the market is unpredictable, especially in today's environment. That's it for today, folks. Hope the video was helpful. Hit that subscribe button for more videos like this. Thanks for watching and I'll see you in the next one.